When Lindsey Vonn crashed in Cortina, the world gasped at the physical agony. But if you pause that frame at the 33-second mark, you weren't just looking at a broken tibia. You were watching a high capital expenditure business asset suffer a catastrophic liquidity event. To the average viewer, this was a tragedy. To the sports business insiders managing her portfolio, this was a calculated risk that just triggered millions in insurance clauses and contract contingencies. Vonn isn't just a skier, she is a corporation with a valuation exceeding $100 million. Her return at 41 wasn't merely for a medal, it was a leveraged bet to secure a final tier of legacy equity. Most people think this crash ruined the investment. They're wrong. The financial reality of icon failure is far more complex and potentially more profitable than a gold medal ever could be. Here is the brutal accounting of the crash. To understand the crash, you have to audit the setup. Why risk a surgically repaired knee at 41? Because in the legacy return model, the final comeback is the most lucrative product launch an athlete can execute. Before she even stepped into the start gate, Vonn's brand valuation was operating at peak efficiency, generating an estimated $8 million in annual endorsement revenue. This wasn't passive income, this was active campaign capital, tied specifically to her participation in the 2026 games. Partners like Red Bull, Under Armour, and Rolex likely structured specific comeback clauses into their contracts. These aren't standard retainer fees. These are performance-based accelerators that multiply payouts based on media impressions during the Olympic window. For Under Armour, specifically the Project Rock partnership, Vonn represents the ultimate validation of hardest worker in the room. NBC and the IOC relied on this star power premium to drive viewership in a fragmented media landscape. They needed a protagonist, and Vonn was the only asset capable of cutting through the noise. But the risk profile here was astronomical. Compare this to Bode Miller's 2015 World Championships crash. When Miller's hamstring tore, it ended a season. When Vonn crashed, it threatened an entire business vertical. Speed events for aging icons are high-variance gambles. The difference is the sponsorship shield. Brands pay a massive premium for active legends versus retired legends. An active Vonn wearing a Red Bull helmet in the start gate is worth 10x more than a retired Vonn wearing a Red Bull hat in the commentary booth. That disparity created a multi-million-dollar incentive to risk physical health. It creates a scenario where the athlete is incentivized to ignore biological red flags because the active roster bonus is simply too high to leave on the table. The strategy was sound. Leverage the last dance narrative to lock in long-term equity deals that would pay out for decades. But the market has a way of correcting itself. When she hit the net, that correction was immediate. The crash didn't just break a bone, it shattered the projected Q1 2026 revenue waterfall. The asset went from active and appreciating to distressed and depreciating in less than a minute. Now we have to open the books and see exactly what that depreciation looks like. Let's deploy the brutal accounting framework to audit the immediate costs of this crash. In corporate finance, when heavy machinery breaks, you have maintenance capex, the capital expenditure required to get the asset back online. For Vonn, the tibia fracture represents a maintenance capex of approximately $100,000. This covers the complex orthopedic surgery to stabilize the bone with titanium rods, the operating theater costs, and the immediate post-op hospitalization. This isn't covered by a standard HMO. This is specialized, private-tier medical intervention designed to preserve future functionality, not just current health. Then you have the operational expenses, or OPEX. For the next 8 to 11 months, the cost to maintain the asset without generating competition revenue will skyrocket. We are looking at $50,000 to $150,000 for specialized rehab, private physical therapy, and the hyperbaric chambers required to accelerate bone healing at age 41. This includes the opportunity cost of training time. Every hour spent in rehab is an hour not spent creating content or fulfilling sponsor obligations. This is cash burn with zero immediate return on investment ROI. However, the real financial hit is the revenue void. The crash likely vaporized between $2 million in medal bonuses and immediate post-Olympic victory lap campaigns. If she had crossed the finish line, even in the top 10, the media tour would have generated appearance fees and new short-term partnerships. A gold medal bonus from a primary sponsor can range from $500,000 to $1 million alone. That revenue stream is now zero. To mitigate this, her management team would have secured high-limit disability insurance. Unlike standard medical coverage, these policies are designed for loss of value. We can estimate payouts between $500,000 and $1 million, depending on how the policy defined career ending versus season ending. This is the hedge fund approach to a human body. You short your own health to protect the downside. These policies are complex financial instruments, often underwritten by specialty markets like Lloyd's of London, specifically to cover the gap between injured and insolvent. Finally, we have to look at the contracts. Brands might invoke force majeure clauses, usually reserved for acts of God, but often written to include catastrophic injury that prevents contract fulfillment. Interestingly, standard morals clauses don't apply here. Breaking a leg isn't a scandal, it's an occupational hazard, but performance clauses are strict. If the contract required 5 starts and she only made 1, the prorated reduction in revenue is automatic. The balance sheet is currently bleeding cash, meaning the strategy must immediately shift from performance marketing to resilience branding. Here is the counterintuitive twist that separates wealthy athletes from true business empires. While the immediate balance sheet shows a massive short-term loss, icon failure often increases long-term brand equity. We need to apply the CEO scorecard to understand why. When an athlete dominates, they are admired. When they break and rebuild, they are idolized. Look at Tiger Woods. Following his scandals and catastrophic back surgeries, he lost an estimated $22 million in endorsement deals. However, the brands that stayed, like Nike and Rolex, saw their ROI compound. Why? Because the narrative shifted from unbeatable machine to human resilience. That struggle sells more product than perfection ever could. Woods proved that loyalty equity, the value generated by sticking with a hero through the mud, is stickier than fair weather fandom. Serena Williams offers a similar case study. Her return to tennis after childbirth and a pulmonary embolism didn't yield the record-breaking major title count many hoped for. From a performance standpoint, the comeback was statistically average, but from a valuation standpoint, it was a unicorn event. It skyrocketed her business profile, helping drive Serena Ventures to raise $111 million. The resilience narrative opened doors to venture capital partners who value grit over gold medals. Lindsey Vonn is now entering this exact transition. Her primary sponsors, specifically Under Armour's Project Rock and Land Rover, are not paying for a 41-year-old to ski fast. They are paying for the unbreakable spirit. Land Rover doesn't sell speed. They sell the ability to handle rough terrain. A shattered tibia is the ultimate rough terrain. This triggers the pivot protocol. Her management team is likely already restructuring the asset to sell the recovery journey rather than the athletic result. The deliverables in her contracts will shift from Olympic appearances to recovery content. We have seen this playbook execute before, documenting the surgery, the first steps, the agony of rehab. Marketing data consistently shows that struggle content generates significantly higher engagement rates than victory laps because it is relatable. A gold medal is alien to the average consumer. A broken bone is visceral. By documenting the hell of recovery, Vonn converts a $200,000 medical expense into a multi-part docu-series potentially worth millions in licensing fees. She trades the podium for the platform. This is how you hedge the risk of physical collapse. You ensure the camera is rolling when you fall, turning the equity of pain into a new revenue stream. This financial pivot separates the wealthy athletes from the true business empires. So what is the final audit of this crash? The brutal accounting tells us that the incident cost millions in short-term revenue, vaporizing performance bonuses and victory tour fees. But in the long term, it likely secured the legacy asset for another decade. For aspiring sports executives, here is your asset management playbook. First, you must diversify the equity of pain. Ensure your contracts are structured to monetize the journey, not just the podium. If the asset breaks, the contract must allow for a pivot to digital storytelling, where the recovery becomes the product. Second, structure insurance policies as revenue replacement vehicles, not just medical coverage. You need high-limit disability policies that pay out on loss of future earnings, effectively acting as a hedge fund against biological failure. Finally, the ultimate takeaway is simple. In the high-stakes business of performance sports, the most valuable ability isn't availability, it is marketability in the face of disaster. Lindsey Vonn didn't walk away with a medal, but if she executes the pivot, she walks away with a business empire that is unbreakable.